Hello everyone and welcome to today's video, which is the series on what I would do differently in property. And that is looking at self-funding or banks, which is the best way to grow a property portfolio and increase your buy-to-lets. So when it comes to funding, some people have a very clear idea of how they want to grow their portfolio. And very often that is kind of in one of two or possibly three ways. The first is self-funding. So they will look to save up the funds available before they even go and look at or consider purchasing their next property. And that's all of the funds. So that's everything to purchase it in terms of total property price, everything they need in terms of purchasing costs, and everything they need in terms of any potential refurbishments as well. The second element could be a combination of using self-funding and also bank finance. So maybe raising enough money with savings to pay for deposits. And typically that could be around sort of 25% of the purchase of the property, but also then buying costs. So you might have any agency fees, you might have conveyancing fees, insurance, and then possibly any sort of maintenance or refurbishment as well that you're planning. But your total investment into the property is minor. The third option, which some people consider, but isn't often talked about or often kind of known about, is using and working with other partners to grow a property portfolio, where you might not have the resources in terms of physical cash resources to input, but maybe you have the skills, maybe you have the experience or the contacts or the deal flow. Maybe you have lots of properties that you're seeing on a regular basis. And then there's another party there that you can partner with that does have the availability of the funds, and they're cash rich, possibly time poor, and they want to invest in property, but they just don't have that level of time or experience or contacts within the industry to really grow their own portfolio, and they're comfortable with partnering with others. So these are the three options that we see most people looking to kind of grow a portfolio. And I'd say to kind of consider them all at the start, depending upon what you're looking to kind of do with your portfolio. So be open to them all, but have a very clear idea of how you're looking to kind of grow, because most people fall into one of the three camps without any form of kind of planning. And that's what I would do differently, is not necessarily focus on one particular aspect and say, you have to do it this way, as in you have to self-fund, or you have to use leverage and get bank financing, or you have to do it with kind of joint ventures and partners, because there is absolute downsides and risks to all of those kind of routes. I think it's important though to have a very clear idea of how you are looking to kind of grow your portfolio, so you can really kind of build it with a strategy and a plan and fundamentally an end goal in mind. Because what we often see is people starting and they're getting to a stage where they hit a very clear kind of block or brick wall, where they just have no ability to kind of grow that portfolio because they hadn't considered what happens after the purchase. And there's a very common, I suppose, use case or example here that I kind of give, which is, especially where you see investors that are maybe looking to grow a buy-to-let portfolio, is they have a certain amount of funds available and they purchase the property, they tenant it, but then they're not able to purchase the next property because they hadn't considered where the funds for the second property would kind of come from. And that matters because you need to consider timings, you need to consider availability for finance, you need to consider whether you're going to buy a property that requires refurbishments and you're going to add some value. Or if you're looking at a property that's going to be purchased at a discount, so you can lock in some value straight away on day one, and then maybe look to refinance that property in the future. Or if you're looking at a portfolio of properties, maybe you're looking at buying an existing portfolio, looking to create a portfolio of properties, and you want to leverage some advantage there by bringing those properties together and then getting some better funding across that portfolio rather than one individual property. There's a myriad of things to consider, but that's very often missed when people are starting in property or looking to kind of buy the next property. They're blinkered, they're focused on that one property, and they're not considering kind of the next steps and the future steps. So the thing that I would say is worth considering is a 6-month, 12-month, and 5-year plan on how you are looking to kind of build and grow that portfolio. So whether you're looking to stay with one property, that's absolutely fine and can work fantastic. Or if you're looking to grow a large portfolio of properties, it's not easy to do unless you have a very clear idea of what that end goal is in mind. And many people miss that kind of 5-year plan. So I'd say to definitely kind of consider that. And also when it comes to bank financing, self-funding, or looking at kind of working with investors, if you are looking at banks, if you are looking at kind of working with investors, make sure you do your research, make sure you do your due diligence. And this is both for high street banks all the way through to individual investors, because there has unfortunately been multiple stories over the last sort of 15 years I've been involved in property where investors have been all in on one particular option. So maybe they had only one bank across all of their properties, and then there was a problem with that bank and that created problems. Or they had one key investor they were working with, and there was a problem with that investor and that created kind of problems. So making sure you de-risk your portfolio, making sure you de-risk your plans as best as possible. And then just stay open to all of those three options, whether it's self-funding, bank financing and leverage, or working with investors or partners. I don't think there's necessarily a silver bullet and a perfect way of doing it. It's personal preference. There's many people I speak to that would only ever consider kind of one of those routes and wouldn't consider the others. And there's lots of good reasons for that. So it does come down to kind of personal choice, but I hope that helps. Hope that gives some context and insight as to maybe the options available to kind of grow a portfolio when it comes to kind of funding and why you might kind of consider that. And if you are going down the bank route, speaking to brokers that have experience with multiple lenders. If you are going down the investor route, speaking with multiple investors to give you a wide range and picture as to the potential partnerships that are out there, and finding the one that's a good balance for you, because you don't want to have a similar skill set as somebody else, because it doesn't really give you the chance to leverage each other's skill sets as much as you would do if you had somebody with opposing skill sets than you and maybe can bring something else to the table. Hope that helps. Any questions, please feel free to ask, and look forward to catching up with you in the next video. All the best.